Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, today we're going to talk about 4 myths of the housing market.
Great.
These are 4 myths. This is from Realtor.com. These are current myths, things that are happening right now that you have been told. You probably heard about them from a doomer or someone just spouting fake information. But fortunately, Realtor.com watches our channel.
Right.
And then they put together this article.
Well, so we're feeling a little bit like Mythbusters, aren't we?
We're the Mythbusters for real estate.
Right.
Okay, so let's start with the first one. The housing market is about to crash just like 2008.
Dun, 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 dun.
Oh my God, it's going to crash just like 2008 because everything's exactly the same, right?
Right. So it's just like 2008. We have lots of people buying houses and speculating. We have easy credit where you don't have to fog up a mirror, but it's helpful.
Nope.
We have the 125% purchases.
Nope.
We have builders overbuilding.
Nope.
We have
ARMs, adjustable rate mortgages.
Right, we have adjustable rate mortgages.
1-year adjustable rate mortgages.
Yes. So we have all those things, right? I can't hear you.
No.
Not so much.
You have to yell at your computer louder because none of those are the case. Here's the first quote from the article. Unlike today, there was a glut of new homes being built then. Sellers were trying to attract buyers, and home buyers could qualify for a mortgage with little to no money down. That's a very cursory summary of what happened. But by the end of 2006, when we called basically the housing crash on our radio show, which was called Talk About Houses, that there were over 4 million homes available for purchase in the U.S. Today, there's like 400 or 500,000. Like there's about a tenth of the number of homes available for purchase as there was back then.
To give you an idea, the number of homes available for purchase back then is about the same as is going to be purchased in the U.S. in the entire year.
There was a year of inventory. Right now, we have 40-something days of inventory in the U.S. It's probably an eighth. Mm-hmm. That's the amount of inventory we have, okay? Nothing like 2008. It's certainly not going to crash. And we're back to year-over-year price increases, mm-hmm. year-over-year inventory declines, and we never had that from 6 to 7 to 8 to 9 to 10. For 5 years, we never had that. Every year it was down. It was just down, 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 and never went up like it's doing now.
Right.
Okay, number 2. Owners have such good rates, they will never sell.
Well, so never is a long time, right?
Okay.
So, yes, sellers do have really good rates on their mortgages. There's no arguing that. And sellers are becoming accidental landlords because they've got these great rates and they don't want to let go of them. And so when they purchase something else, they are keeping the existing house because it's got this killer rate. I'll give you that. But there are life circumstances, right? So, you might live in one state and maybe your parents live in another state and they pass away. You're not going to probably become an accidental landlord, several states removed. You're probably going to sell that property. That's just likely. Other life circumstances, same kind of thing. Maybe you get a job transfer several states away. You're probably not going to become an accidental landlord. You're probably going to sell because it's hard to deal with properties that are that far removed from you. So there are all kinds of circumstances. Maybe, you had triplets and that, 1-bedroom fabulous condo just isn't cutting it. Yeah. And you just need the money out of it to make it happen with the next place. All kinds of reasons why people will still sell. Now, will they sell as frequently as they used to? Probably not. But will people still sell? Absolutely.
I'm going to read the quote and then I'm going to ask you a question.
Okay.
Because you know a lot. Mortgage rates were forced lower than they should have been. It was artificial. It was a result of pandemic and a very, very slow economy. The Fed basically dropped interest rates to zero. Mm-hmm. People could borrow money almost for free. Lower than they will likely ever be again. So when you look at it from the seller's point of view, it doesn't make sense to give up a low long-term rate. There are certainly people, you're traditional process is I'm going to move, I'm going to sell the house, take the equity to the next house. Because I had a 6% interest rate and interest rates are now 5.5%. So why would I want to keep that 6% rate? I'd trade it in for a lower rate. That's what people did for decades, for at least from the 80s till a couple years ago, because interest rates fell over the course of 40 years. But that's not the paradigm. The paradigm's completely different. We probably will never see 2.5% interest rates. People have those loans. So what goes through their head now when they're moving from San Diego to Vegas?
Right. So they have they're going to be struggling to figure out what to do. So there will still be people who say, you know what, I'm still not giving it up. I'll go ahead and rent it out, get a property manager, and I'm still going to hang on to it. But a lot of people are going to say, you know what, it's just too far away, and I'm still going to go ahead and sell it even though I've got this great interest rate. So it's going to be on everybody's particular circumstance. But what you're going to see is people who are not moving out of the area. Those people are less likely to sell because those people are not as incentivized to sell, right? It's easier for them to become accidental landlords rather than somebody who's moving across the country.
Also cash buyers.
Right. So
that don't need the money from their other house.
Right.
That's probably paid off too.
Right. So we are seeing a lot of that where, somebody who purchased the property cash and they're going to sell it and they're going to buy their next property cash. So they're not subject to the whole interest rate drama.
The people who are not selling their houses that are buying a new house, Gen Xers and boomers, they're accumulating wealth that they will eventually pass on. But remember, they're not going to, the youngest Gen Xers are in their early 40s. They're not going to die, they're going to be around 40 years from now. So they're going to be around for a while. Okay, here's the third myth. As rates rise, home prices will drop.
Well, we know that hasn't been the truth, right?
Oh my God.
Because we've seen rates double in the past year and home prices have not dropped.
They've gone up in the last 18 months. They're up substantially.
Right.
Since interest rates went from 3 to 6.5, the housing market's up 5 to 10%.
Right.
Over 18 months.
Right. So that's certainly not the case. Now, we acknowledge that the housing market is not up everywhere and it's not up equally everywhere because remember, real estate is hyper-local. But when we're looking at the housing market by and large, real estate prices either are relatively unchanged or for the most part, they are up.
We just did a market update for Vegas yesterday. Vegas is down about 2 or 3% year over year. Certainly not worth having sold the house and having to rebuy it. Huge mistake for anyone who did that. Okay, here's a quote. Some buyers are dating the rate and marrying the house. We did a video on that. Today's high interest rates can be refinanced in the future. Truth. And today's housing prices will likely be higher when those lower interest rates return. Wanda, do you think that's why as soon as the house comes on the market, it's getting grabbed up? Because people are saying, yeah, I know I have to get some financing, but I'd rather get that house now than pay 30, 40, 50, 60,000 more a year from now. And then I'll just refi my current mortgage in a year. I'll kind of win on both sides. I'll get today's price with tomorrow's interest rate.
Well, not only that, but while there are probably still multiple offers if the house is desirable, certainly not as many multiple offers as there will be once the interest rates drop, and certainly not having to overpay over the asking price as much today as somebody might when there are considerably more offers on that property. So there are a lot of different things to consider. And it actually may make financial choice depending on the situation to say, hey, you know what? Yes, I know I'm paying more interest, but I'm actually saving money because I'm not having to overpay for the house later when I'm bidding with everybody else. And on top of that, I'm getting the house that I want, which may or may not be available at a later time.
I was looking at a house in kind of a higher end area and it was pretty expensive. And I talked with my lender about it and he said, those houses are going up about $125,000 a year. And I go, yeah, I know. I can see. I've been watching it for like the last few years or more. He goes, about every maybe 7 or 8 years, it goes up $1 million. He goes, yeah, it's going up faster than you would be making your interest payment, not counting your principal production. Your interest payment's a lot less than that. Plus you get the tax break and all the other benefits he was telling me. He goes, you're definitely better off just buying it, even though interest rates are high, and refi a year or whatever. And I did the math, and the math actually made sense. I was like, yeah, when you get into the $2-3 million homes that are going up so much, and you realize that, you know, even though the interest rate seems kind of high, the payment's kind of high, the home is still appreciating faster than your payments would. So it's kind of a arbitrage, right? You're, and this is what we dealt with in the 70s with high inflation. People had, homes were going up faster than their per month than their mortgage payment was. So it was, that's why people kept buying in the 70s and 80s.
Right.
Okay, fourth myth. We've covered this extensively. Good credit buyers are subsidizing buyers with bad credit. This got political because the White House came out and made a big statement about the FHFA, who changed some of the numbers, but they didn't make people who are higher, richer people take money and then give that money to poor people to pay for a house.
No, so a couple things. First of all, FHFA has to do with the, with Fannie Mae and Freddie Mac, right?
Okay, GSEs.
So with the GSE. So if you're buying a property cash, has nothing to do with you. If you're doing a jumbo loan, it's got nothing to do with you. So
FHA and VA, nothing. Even though it's FHFA, it's not the FHA. Right. Completely different.
So so it's a whole different ballgame. People with good credit still get good benefits. People with bad credit still pay more money. So all of that was just blown out of proportion. And it was interesting to me because the administration tried to come out and kind of do this class warfare thing, and it just came back and bit them in the hiney. So I always like it when politicians kind of get smited a little bit.
Yeah. So here's a quote for the article. The myth blew over a misunderstanding about government-backed Fannie Mae and Freddie Mac loans and a new fee structure. The next quote is, the new fee structure eliminated upfront fees for first-time home buyers. Okay, doesn't really matter whether you're super rich or not. If you're a first-time home buyer, it eliminated some upfront fees for you.
But generally speaking, of course, first-time home buyers tend to not be the super rich, right?
I happen to know a person who makes $300,000 a year. Their spouse makes $175,000 a year. They're about 30. They're married with no kids, and they're buying their first house.
Right.
And they're first-time home buyers, and they make like almost $500,000 a year, and they're obviously looking at over $1 million homes for their very first house ever, and they're not. So they're super rich, and they're going to benefit from this too.
Right, but I think that they're more the exception.
Okay.
And the other thing to keep in mind is that Fannie and Freddie, their job is to facilitate and encourage first-time home ownership, and to provide liquidity to the market so that the lenders have money to loan out.
The people who had to pay more were second home loans, high balance loans, high end, super, $4 million houses, because they need to balance out the total package. If you look at the chart, we've done this many times. The higher your credit score is, the less you pay in interest. The lower your credit score is, the more you pay in interest. No one's subsidizing anybody. But this turned into a fake political thing. And here's a quote, the last quote from the article. It's a myth. Buyers with poor credit always pay a higher interest rate than buyers with good credit. And we showed the chart before. There's nowhere on that chart where anybody in any of depending on how much you were putting down, paid more than somebody with bad credit. And then it was the only ones that changed were 20 to 30% down. So if you're putting less than 20% down, it didn't change. If you're putting more than 30% down, it didn't change. And then this myth that super poor people that were putting 30% down were getting a better deal. Like, what super poor person is out there putting, $200,000 down on a house? The whole thing was nonsense. Anyway.
So anyway, this was our myth busting.
Myth busting.
I know that we are nowhere near as sexy as those myth busters.
Well, they're on like national TV, and we have 50. They get 50,000 views a minute. We get 50,000 views a month.
There you go. Feel free to subscribe, hit the notification bell, share the video, like the video, leave us comments, tell us what you think. You don't have to agree with us. We welcome your comments, and we will see you on the next video. Bye.
Bye.